Let's get to Phil LeBeau and his special guest, GM CFO Paul Jacobson. Phil, good morning again.
Good morning, Becky. Paul, thank you for joining us today from General Motors headquarters in Detroit. Let's get right to the matter that everybody's discussing when they look at your earnings results. Yes, you beat the street on the top and the bottom line, but your earnings tumbled about 25% year over year. How much of that is due to the tariffs that were put into effect in early April?
Well, good morning, Phil and team. Thanks so much for having us today. It's a beautiful day here in Michigan, and we're pleased to report another quarter of, I think, strong momentum that we've seen. Tariffs are obviously a big story for us, as we've seen throughout the quarter. They impacted our quarter by about $1 billion, $1.1 billion, in line with our expectations that we laid out earlier in the quarter when we talked about a $4 to $5 billion impact for the year. So we're in a bit of an adjustment phase right now, but I think the team is really firing on all cylinders right now.
Your margins, they dropped overall 6.4% compared to 9.3% a year ago. But North America, that's really the profit driver for you guys. Your North American margin, 6.1% versus 10.9%. Is this the new normal? If you're an investor in GM, is this the new normal in terms of the margin range to expect because of the tariffs that do not appear to be going away?
Well, actually, what we expect is this was going to probably be the peak of the tariff impact for us. While we've experienced a little bit of timing pushback from some of the indirect tariffs that we will see later in this year, we'll begin to work in the 30% offsets that we've talked about. So we've uncovered a number of initiatives. We've been working on these really since the beginning of the year, really into the end of last year. Those 30% offsets will start rolling in the back half of the year, and we actually expect the margin impact to be lessened from the tariffs. It was about 300 basis points this quarter, which explains the bulk of the difference between margins last year and where we were in this quarter. But I think we've got a path to begin to mitigate some of that in the short run. And then longer term, many of the manufacturing announcements that we made earlier in the quarter about onshoring production here into the U.S. with $4 billion of capital initiatives are going to have an effect as we get 18 to 24 months down the road. So we've got a good plan in place. And in the meantime, we're continuing to generate strong cash flow and investing in our great suite of products.
What about Korea in terms of you import a number of vehicles that are built there, highly successful vehicles that are in demand. If there cannot be a trade agreement worked out with Korea and we see the tariffs staying in place, who knows at what percentage, but staying in place, do you keep production where it's at there, or do you look at some of that being onshored as well over the next couple of years?
Yeah, Phil, we haven't made any long-term decisions about Korea yet, mainly because there is a lot of uncertainty about that. What we said is that with the current tariffs in place, the vehicles that are coming over are still contribution margin positive. So what we want to do is make sure that we keep that flow going for our customers. As you mentioned, that vehicle is in strong demand. We've seen it particularly on the lower end of the pricing curve. It's a great vehicle for our customers. So we want to keep that coming. Obviously, we're watching very closely the trade discussions. We're optimistic that the U.S. and Korea can find common ground. We know the auto industry is important to both sides in those conversations. So we actually believe that there's some reasons for optimism from seeing in the news, but we're going to continue to watch it. In the meantime, it's important to make sure that we keep the vehicles flowing for our customers. And like I said, they're contribution margin positive in the short run, so it allows us to buy a little time while we work through that uncertainty.
Hey, Paul, I know to this point GM has been not passing on the cost to consumers. You've been eating it, and that's why you see the lower margins. Is there a point where you say, OK, we can no longer degrade our margins to this point? We have to think of the shareholders, too, and you pass some of those higher costs from the tariffs on to the consumer?
Yeah, well, good morning, Becky. What we've been trying to do for the last few years is really make sure that we differentiate ourselves in terms of pricing. So while we've seen a lot of heavy incentives from our competitors over the last few years, we've maintained a lot of pricing consistency. And we think that's important for our customers to make sure that they can count on us, but also to make sure that we're watching and monitoring residual values because our customers do hold on to these vehicles and want to make sure that they maintain their value. So that strategy is actually actually served us well. When the tariffs were first announced, we announced that we didn't need to take any incremental pricing increases to offset tariffs, and we wouldn't be responding. But when you look at the first quarter, pricing was up. Second quarter pricing was essentially flat, but we've banked some of those gains, and that's part of our 30% offset that we've talked about. So we don't expect any specific price increases related to tariffs, but certainly pricing and stability is important for us as we continue to manage our inventories with discipline and really drive the business for cash flows.
Paul, do you expect that to be the case with the industry too? I mean, let's be clear, incentives are going up. Some of your competitors are raising incentives. And when I've talked with executives at other companies, everybody says the same thing. As the pre-tariff inventory burns off, at some point, you start to see people within the industry, I see people, I'm talking companies, say, okay, we've got to start moving prices up here. Do you expect that to change?
Well, I think we're obviously watching it. We watch it every day. But, over the last few years, we've seen competitors get into inventory challenges and increase their discounts. We've seen companies out there really trying to buy market share. But that's not something that we've responded to. And if you look at our performance, our pricing has been consistent. We're operating near the lower end of the industry in terms of incentive levels, which is important. Our customers have an understanding then of how much the vehicles cost, and that consistency is really important. And through that strategy, we've actually been picking up share. We gained almost a full point of share year over year in the second quarter, despite what others have been doing in terms of some discounting. So we'll watch that, and we're ultimately pricing to the demand for our vehicles, and right now that demand remains very strong.
Hey, Paul, real quick, when it comes to EVs, you guys highlight in your earnings release that you've had some success, some notable success in North America in terms of picking up EV market share, becoming the number 2 brand in terms of Chevy behind Tesla. But there are more than a few people who look at the EV market and they say that $7,500 tax incentive goes away on September 30th, and this is what's going to happen with EV sales. What's your perspective?
Well, we're absolutely committed to continuing on our journey of getting to profitable EV growth going forward, and we've made some great progress. As you mentioned, our EV sales doubled year over year, and we're experiencing significantly higher growth than what the rest of the industry is, even as demand is slowing. We expect actually there to be a little bit of a rush on EVs. Those customers that are very interested in EVs, obviously, I think are going to come to us and come to others ahead of the expiration of the $7,500 tax credit.
But after September 30th.
And then, we're likely, yeah. And then we're likely to see it slow down a little bit after that. But, I think what we're looking for is over the long term, a lot more stability in the electric vehicle market. What we've seen is a lot of irrational behavior by some of our competitors that are really selling vehicles to buy compliance. So as Congress has taken action to ultimately balance out the EV mandate to where customer demand is, we think we can be there for our customers. So we actually feel like we're in a very, very good spot. Demand has been slowing, but despite that, it's been growing for us, and that's because we're bringing a suite of great products to the market that have features that customers love, and we think we can keep that momentum even in the face of a slowing EV growth, and that'll ultimately help us on our journey towards profitability.